There is a metal sitting in your safe right now, or in a vault somewhere with your name attached to it. And the most powerful financial institutions on the planet would very much prefer that you sell it before the market opens on Monday morning. Not because it has lost its value, not because the story has changed, but precisely because the story has not changed. And they know it, and they are quietly, methodically, and rather desperately hoping that you do not. That is not a conspiracy theory. That is an incentive structure. And understanding the difference between those two things is perhaps the most important financial distinction you can make in the year 2026. Let us begin where all serious analysis must begin. Not with the breathless predictions of retail commentators. Not with the fever dreams of gold bugs who have been wrong for 20 consecutive years, but with the cold arithmetic of what is actually happening in the physical silver market right now, in this week, in this moment. Because this week, something rather extraordinary occurred in the silver market, and it occurred with almost no coverage in the mainstream financial press. COMEX registered silver inventories, the metal formerly certified as deliverable against futures contracts, have now fallen to approximately 86 million ounces, representing a coverage ratio hovering near 16% of outstanding paper claims. That is a number that, in any sober reading of commodity market history, qualifies as stress territory. Paper leverage stands at roughly 6.2 times the deliverable metal, more paper claims than real silver, and the July 2026 contract's first notice day is barely a week away, with tens of thousands of contracts still open. Now, let me explain to you precisely why that matters, because it is not immediately obvious, and the financial media has done a rather spectacular job of ensuring it remains so. Silver trades in two worlds simultaneously. There is the paper world, the futures contracts, the options, the swaps, the institutional positioning that takes place on the COMEX exchange in New York. And there is the physical world, the actual metal, the bars, the coins, the industrial inventory sitting in vaults and awaiting shipment to solar panel manufacturers, electric vehicle producers, and semiconductor fabricators across the globe. For most of silver's trading history, these two worlds have maintained a workable relationship. The paper market set the price. The physical market accepted it. Arbitrage kept the gap between Eastern and Western prices narrow. And the whole elegant machinery hummed along with the kind of institutional confidence that only exists until the moment it does not. What is happening in June of 2026 is that this machinery is grinding. It is not broken. Not yet. But it is producing sounds that experienced commodity analysts recognize with considerable unease. Silver touched an all-time high of $121.62 per ounce on January 29th of this year, a number that would have seemed hallucinatory to anyone writing a silver analysis in 2023. Then the CME, the exchange that runs COMEX, raised margin requirements from 15% to 18% in mid-February, triggering a violent 26% single-day correction that remains one of the most dramatic single-session declines in modern precious metals history. Silver crashed from that all-time high down towards $63 before staging a recovery. As of this past week, spot silver was trading in the range of $64 to $66 per ounce, following a roughly 4.5% weekly decline driven by a stronger dollar, Federal Reserve hawkishness, and the easing of geopolitical risk premiums after the signing of a U.S.-Iran peace framework. And here is where careful, rigorous thinking separates the serious observer from the casual one. Because the mainstream financial media looks at silver down from $121 to $64 and concludes that the story is over. The move happened. The bubble inflated and deflated. Time to move on. This conclusion is not merely premature, it may be precisely backwards. Consider the structural foundation beneath these prices. The Silver Institute, not a fringe outlet, not a retail silver promoter, but the preeminent industry research body, projects that 2026 will mark the sixth consecutive annual deficit in the silver market. Supply falling short of demand for 6 straight years. The projected shortfall for this year alone is approximately 67 million ounces, following a fifth consecutive deficit of 40.3 million ounces in 2025. And the cumulative shortfall since 2021 has now climbed above 820 million ounces. 820 million ounces. That is, by striking coincidence, roughly equal to 1 full year of global mine production. The world has been burning through its above-ground silver stockpile for half a decade, and the mine supply pipeline offers no rapid relief. New silver projects require 7 to 15 years from discovery to production. You cannot simply flip a switch. To make matters considerably more interesting, approximately 75 to 80% of global silver supply is produced not from primary silver mines, but as a byproduct of copper, zinc, and lead mining. This is the silver market's most underappreciated structural complexity. Silver supply is not directly responsive to silver prices. If copper economics do not justify increased mining, silver output does not increase, regardless of what silver is trading at. The metal is a passenger on another commodity's train. Now let us introduce the demand side of this equation because it transforms what might otherwise be a moderately interesting supply story into something considerably more consequential. Industrial demand for silver now exceeds 700 million ounces annually, driven by applications that are, in the blunt language of materials science, essentially irreplaceable. Silver is the best electrical conductor of any element. It is used in photovoltaic cells for solar panels, each panel requiring a measurable quantity of the metal. It is used in electric vehicle components, in 5G infrastructure, in AI data center construction, in medical imaging, in water purification, in virtually every category of technology that the modern world has decided is essential to its future. Global photovoltaic installations set a record in 2025 and are accelerating. The electric vehicle transition is consuming tens of millions of additional ounces annually, and China's silver imports in early 2026 reached their highest level in 8 years. This is not sentiment, this is not speculation, this is industrial procurement. And it is happening simultaneously with investment demand. Western physical investment forecast to rise 20% in 2026 to a 3-year high of 227 million ounces, as retail investors who missed the extraordinary run of 2025 begin entering the market. The paper market suppressed the price violently in late January. The margin hike worked, in the narrow technical sense that it reduced leverage and sent futures traders scrambling. But margin hikes do not resolve physical shortages. They do not create new silver mines. They do not reduce the number of solar panels being installed in China, India, and across the American Southwest. They buy time. And the question that the most sophisticated market observers are now asking, in the weeks following that extraordinary volatility, is a very simple one. How much time did they actually buy? Let us talk about Bank of America. Because when the largest commercial bank in the United States by assets publishes a research forecast, it is not performing theater for retail investors. It is communicating analytical conclusions to portfolio managers, hedge funds, pension funds, sovereign wealth funds, and the institutional community that collectively controls trillions of dollars of capital allocation. Bank of America's head of metals research, Michael Widmer, has maintained a silver price target for 2026 ranging from $135 to $309 per ounce. The $135 target is derived from applying the 2011 gold to silver ratio low of 32-to-1 against current gold prices. The $309 target applies the 1980 extreme of 14-to-1, the level reached during the Hunt brothers silver squeeze that remains one of the most dramatic commodity market episodes in recorded financial history, with gold currently trading near $4,100 to $4,400 per ounce. The mathematics are straightforward even if the outcomes are not guaranteed. Now, a price target is not a prophecy. Widmer himself has been careful to note the price could cap at $309 rather than asserting it as certainty. The Reuters poll of 30 institutional analysts currently projects a 2026 average silver price of $79.50 per ounce, considerably more conservative than Bank of America's bull case, but still substantially above current trading levels. JP Morgan forecasts an $81 average. Citigroup has published a $150 to $170 target. Even the most cautious institutional voices in this conversation are not describing the silver story as finished. What the existence of these forecasts tells us is something important and often overlooked. The question of whether silver goes to $135 or $309 or $80 matters considerably less than the fact that major institutional research desks are modeling those outcomes at all. Because when institutional research acknowledges dramatic upside scenarios, institutional positioning begins to follow. Not immediately, not uniformly, and not without volatility and reversal along the way. But the direction of analytical gravity has shifted. A year ago, silver was an afterthought in most serious commodity allocation discussions. Today it is not. That transition has consequences. If you are watching this and you hold physical silver, whether it is American Silver Eagles in your home safe, a position in a private vault, or metal stored through a dealer, I want to ask you something directly. Not about what you are going to do, but about what you understand. Because there is a meaningful difference between holding silver because someone told you to, and holding silver because you understand the structural forces arrayed beneath the price. The first is speculation. The second is conviction based on evidence. And the difference between those two postures is the difference between panic selling at $64 and holding through a correction because you understand what the physical data is actually telling you. That physical data is telling us something the spot price chart is not currently reflecting. And to understand precisely what it is telling us, we need to go to Shanghai. There is a price for silver being quoted on the COMEX exchange in New York, and there is a price being paid for silver in Shanghai, and they are not the same price. They have not been the same price for a meaningful stretch of time now, and the gap between them, which analysts have estimated at somewhere between 12 and 15% through much of this volatile period, is perhaps the single most important signal in the entire silver market right now, more important than any price chart, more important than any futures positioning data, more important than any individual analyst's forecast. Let me explain why. Because this requires a brief exercise in the economics of arbitrage, that elegant mechanism by which price differences between markets are theoretically eliminated by traders who profit from buying where prices are low and selling where prices are high. If silver trades at $64 on COMEX, and at roughly $72 to $73 in Shanghai, which a 12 to 13% premium would imply, then in a fully functioning market, The obvious trade is to buy silver on the Western exchange, ship it to Shanghai, and pocket the difference. This process should compress the gap. The Western price rises as buying pressure increases, the Eastern price falls as supply increases, and equilibrium is restored. For this process to work, however, you need something rather fundamental. You need available physical metal and the practical ability to move it efficiently between markets. And what the persistence of a double-digit Shanghai premium tells us, with considerable force, is that one or both of those conditions is currently impaired. Either physical metal in the West is sufficiently constrained that the arbitrage trade cannot be executed at scale, or the logistical and regulatory frictions involved in cross-border metal movement have become significant enough to prevent the gap from closing, or some combination of both. When a market has two prices, one on a screen and one in the real world of physical delivery, eventually one of them has to move toward the other. The screen price can suppress the physical price for extended periods, particularly in markets dominated by paper trading. But it cannot do so indefinitely. Physical reality has a way of asserting itself, usually at the most inconvenient possible moment for the parties who benefit from the paper price remaining anchored. This brings us to the question that I promised you at the outset, the question about why the largest institutional players would benefit from physical silver holders selling their metal. And the answer, when stated plainly, is both obvious and rather illuminating about the structure of modern commodity markets. Large commercial banks and institutional commodity desks carry substantial short positions in silver futures. This is not a secret. It is not a conspiracy. It is simply what market makers, hedgers, and commodity desk operators do as a normal part of their business. They take the other side of trades. They hedge their physical inventory. They manage books that require short exposure to function. There is nothing inherently sinister in this, but here is what matters. When a commodity experiencing genuine physical tightness, a real, documented multi-year supply deficit, begins to see escalating delivery demands on the futures exchange, the risk profile of those short positions changes dramatically. Shorts in a paper market are manageable, as long as the overwhelming majority of futures contracts settle in cash rather than demanding physical delivery. The COMEX has functioned for decades on the assumption, as one analyst characterized it, that nobody would ask for delivery all at once. In early 2026, that assumption came under severe stress. The assumption did not fully fail. The margin hike and the violent correction that followed appear to have arrested the delivery squeeze before it reached its logical extreme. But the episode revealed the fragility that lives beneath the apparent stability of the paper market. If physical silver holders sell, if retail investors panic at a correction from $121 to $64, concluding that the story is over, several things happen simultaneously. Supply comes back into the physical market, easing the pressure on the deliverable inventory. Sentiment cools. Institutional short positions become more manageable. The arbitrage gap with Shanghai has more room to exist without triggering a delivery squeeze. The paper price regains its authority over the physical price, and the entire structural dynamic that was threatening to overwhelm the paper market gets reset for another cycle. This is the incentive. Not malevolence, not coordination in the legally actionable sense, just the alignment of interests that exists whenever one side of a market benefits from the other side losing conviction. Now let us talk about the supply side of this story with more precision, because the production realities of the silver market in 2026 are remarkable in their specificity. Fresnillo, the world's largest primary silver producer, cut its 2026 silver output guidance to 42 to 46.5 million ounces, down from a prior forecast of 45 to 51 million ounces. That is a reduction of 4.5 to 9 million ounces from the world's single largest dedicated silver producer. COMEX registered inventories have declined more than 70% from their 2020 peak, a sustained multi-year drawdown with no reversal in sight. London Metal Exchange silver stocks have collapsed to historic lows. The borrowing costs for silver, the lease rates that institutions pay to borrow physical metal for short periods, have spiked to levels that suggest genuine stress in the available for lending supply. One analysis cited annualized borrowing costs reaching 200%, which in normal commodity markets would be approximately 200 percentage points above what anyone considers sustainable. And there is a geopolitical dimension to all of this that is simultaneously creating headwinds and underlining the structural demand picture. The US-Iran conflict that began in late February of this year drove oil above $100 per barrel and reignited inflation expectations with considerable force, erasing every anticipated Federal Reserve rate cut from market pricing. Silver, like all commodities, faces headwinds from elevated real interest rates and a stronger dollar. The recent peace framework signed between the United States and Iran has eased those geopolitical risk premiums somewhat. Silver pulled back from the mid-$60s further as oil prices dropped and inflation expectations moderated. The Federal Reserve, under Chair Kevin Warsh, held rates at 3.50 to 3.75% in mid-June, with 9 of the Fed's 19 policymakers now projecting at least one further rate hike this year. Markets are pricing a potential increase as soon as September. This is unambiguously bearish pressure on silver in the short term. Higher interest rates raise the opportunity cost of holding a non-yielding asset like silver. A stronger dollar makes dollar-denominated commodities more expensive for buyers in other currencies, reducing demand at the margin. These are not invented obstacles. They are real forces operating on the silver price right now, and any honest assessment of the situation must acknowledge them with the same rigor applied to the bullish structural arguments. But here is the analytical tension that makes this moment genuinely interesting rather than straightforwardly resolved in either direction. The very macroeconomic forces that are creating short-term headwinds for silver, inflation concerns, rate hike expectations, geopolitical uncertainty, are the same forces that historically drive long-term demand for hard assets. A Federal Reserve that is seriously contemplating further rate hikes in an economy already paying 3.50 to 3.75% is an institution responding to inflation that has proven more persistent than the consensus expected. Persistent inflation is, over any meaningful time horizon, an argument for assets whose supply cannot be expanded by central bank decree. Gold already reflects this, trading near $4,165 per ounce as of last week's peace agreement session. The gold-to-silver ratio, currently sitting near 61-to-1, remains above its historical average of roughly 60-to-1 and dramatically above the 32-to-1 low reached in the 2011 bull cycle. The mathematics of ratio compression, if it were to occur, are straightforward. Now here is where I want to push back on something that appears in virtually every bullish silver presentation you will ever encounter, and push back on it not to diminish the structural case, but because intellectual honesty demands it. Silver has a history of violent and prolonged corrections that have destroyed enormous amounts of retail investor wealth. The Hunt Brothers episode of 1980 saw silver run from roughly $6 to nearly $50 per ounce in a matter of months before collapsing back to single digits. Investors who bought at the peak waited more than 3 decades to see those prices again. The 2011 cycle saw silver approach $50 before reversing sharply and spending most of the following decade in the $14 to $20 range. The January 2026 run to $121.62 was followed by a crash that, at its nadir, erased more than 47% of the price. Anyone who bought the all-time high in late January is currently sitting on a loss of roughly 47% measured in spot price terms. That is not a rounding error. That is life-altering financial damage for investors who committed meaningful capital at the peak. The critics of the current silver narrative are not entirely wrong. COMEX inventory movements can include reclassifications and administrative transfers that do not represent genuine physical tightness. Shanghai premiums reflect local supply-demand dynamics, tax treatment, and currency considerations that are not perfectly comparable to Western spot prices. Bank of America price targets are modeled scenarios, not commitments, and the silver market's 6th consecutive deficit does not automatically translate into a price explosion. Deficits can persist for extended periods while above-ground stockpiles gradually absorb the shortfall. What makes the current environment genuinely different from previous silver bull episodes, and what I believe makes the structural argument considerably more durable than pure monetary speculation, is the industrial demand foundation. In 1980, silver's industrial profile was a fraction of what it is today. In 2011, the global solar installation base was measured in tens of gigawatts rather than hundreds. The energy transition was a policy aspiration rather than a capital expenditure reality. Today, silver is not merely a monetary metal that investors buy when they distrust governments. It is an industrial input with irreplaceable applications in the technologies that the global economy has decided are essential to its future, regardless of silver's price. Solar panel manufacturers do not choose to use silver because it is cheap. They use it because nothing else conducts electricity with the same efficiency at industrial scale. Electric vehicle manufacturers do not use silver because of sentiment. They use it because it is in the vehicle. This demand does not evaporate during a rate hike cycle. It may slow at the margin. It does not reverse. This structural distinction between speculative monetary demand and irreplaceable industrial demand is why the analytical community is treating the current silver market with more seriousness than any previous cycle. It is why institutional forecasts span ranges that would have been considered absurd in 2023. It is why the Reuters consensus of professional analysts projects $79.50 for the year even after a brutal correction from all-time highs. And it is why, if you are sitting on physical silver right now and watching the spot price decline from $121 to the mid-$60s, the question worth asking is not whether you feel good about that number. The question worth asking is whether anything has changed about the structural forces that drove the price to $121 in the first place. If you have been finding this breakdown genuinely useful, if it has given you a framework that the mainstream financial press is not providing, then I want to ask you to subscribe right now. Not because subscription numbers are a vanity metric, but because the work of building an audience that takes markets seriously, that demands real analysis rather than comfortable noise, is the only way this kind of content continues to exist. Hit that subscribe button and the notification bell, because the next time something significant happens in this market, and in 2026, significant things are happening with considerable frequency, you will want to know about it before the crowd does. Let us discuss the retail physical market, because it connects the abstract structural arguments we have been making to the lived experience of ordinary investors in a way that no futures chart or institutional forecast can replicate. Across North America, Europe, and Australia, reports from silver dealers in recent months have described conditions that range from elevated premiums to genuine inventory constraints on specific products. American silver eagles, the official bullion coin of the United States Mint, have periodically carried premiums of $5 to $8 above spot, premiums that, at a spot price of $64, represent an 8 to 12% surcharge simply to acquire a government-minted 1-ounce coin. Generic silver rounds from private mints have generally been available at lower premiums, but the lead times for large orders have extended at various points during the 2026 volatility. Some dealers have described back orders running weeks. Others have described holding existing inventory rather than selling into what they expect to be a higher price environment. This last behavior, dealers holding rather than selling, is worth examining because it illuminates something important about where the sophisticated participants in the physical market believe this story is going. A coin shop owner is not a futures desk. A bullion dealer does not have access to the full suite of hedging instruments available to institutional players. When a dealer chooses to sit on inventory during a price decline rather than liquidating, that decision reflects a conviction about future prices that comes from proximity to actual physical supply and demand, from the experience of watching buyers arrive in greater numbers than sellers, of watching specific products become unavailable at any price, of watching the premium over spot widen even as the spot price declines. That divergence between a spot price under pressure from macro headwinds and a physical market where premiums are elevated and supply is constrained is precisely the kind of bifurcation that has historically preceded significant price realignments in commodity markets. It is not a guarantee of anything. The spot price could continue to decline, premiums could compress, and the structural deficit story could take years longer to manifest in price than the most ardent bulls expect. But it is a signal, and signals in markets exist to be read. Now let us construct the honest, balanced scenario analysis that this situation deserves, the kind of analysis that acknowledges both the bull case and the bear case with equal rigor, because anything less than that is advocacy rather than analysis. The bull case, stated conservatively, rests on 3 pillars that are each individually credible and collectively powerful. First, a 6th consecutive annual supply deficit of approximately 67 million ounces, layered on top of a cumulative 5-year deficit exceeding 820 million ounces, represents a genuine and continuing depletion of above-ground stockpiles that must at some point register in price. The only question is when, not whether. Second, industrial demand from solar, EVs, semiconductors, and AI infrastructure is structurally growing in ways that are insensitive to silver's price. Manufacturers need the metal and will pay what it costs. Third, Eastern physical demand, particularly from China, whose imports reached 8-year highs in early 2026, and India, represents a growing marginal buyer that is competing with Western investors for the same finite physical supply. When Chinese manufacturers are paying premiums above Western spot prices, the Western paper price is by definition understating the true marginal cost of the metal. The bear case, equally stated, rests on 3 counterarguments that deserve serious weight. First, the Federal Reserve's hawkish turn, with multiple policymakers now favoring additional rate hikes and markets pricing a September increase, creates a sustained headwind for non-yielding assets. In an environment of 3.50 to 3.75% policy rates and elevated real yields, the opportunity cost of holding silver is real and measurable. Second, the January 2026 episode demonstrated that the paper market retains the capacity to override physical signals through margin increases, leverage reduction, and the mechanical unwinding of speculative positions. The CME proved it could crash silver 26% in a single session. It retains that power. Third, the silver market has confounded supply deficit narratives before. Deficits can persist while prices stagnate if above-ground inventories are sufficient to bridge the gap between mine supply and industrial consumption. The existence of a deficit does not automatically create a supply crisis on any specific timeline. The honest synthesis of these competing arguments is something like this. The structural case for silver over a multi-year horizon is the most compelling it has ever been, grounded in industrial demand dynamics that represent a permanent change in the metal's demand profile. The path to that outcome, however, runs through a macroeconomic environment that is actively hostile to precious metals in the short term, through a paper market that has demonstrated its capacity for sudden and devastating price suppression, and through the genuine uncertainty about when physical tightness translates into price discovery that cannot be papered over. For investors already holding physical silver at these levels, the question of whether to sell is not purely analytical. It is also personal, a function of your time horizon, your financial situation, your ability to absorb further price declines without being forced to sell, and your conviction in the underlying structural thesis. If the structural thesis is correct, if the 6th consecutive deficit year, the declining COMEX registered inventories, the elevated Shanghai premiums, and the accelerating industrial demand are telling the truth about the real market, then selling physical metal at $64 because the paper price declined from $121 would be precisely the kind of decision that benefits the institutional players who are most exposed to a continued physical squeeze. You would be providing relief to a market structure under stress, by returning metal to the deliverable supply pool at precisely the moment when its scarcity is most acute. If the bear case materializes, if the Fed hikes again in September, if the dollar strengthens further, if the paper market engineers another wave of speculative unwinding, then the spot price could test lower levels. The $60 support level has been identified by multiple technical analysts as critical. Below that, the next meaningful support sits somewhere in the $54 to $55 range. These are not hypothetical outcomes. They are live possibilities in a market where macro headwinds are real and institutional short exposure remains substantial. The question is not which outcome feels more emotionally satisfying. The question is which outcome the evidence taken in its totality, assessed with appropriate humility about what any of us can know with certainty about future prices, makes more probable over the time horizon that matters to you. Let us talk about what to watch in the coming sessions, because understanding the market is only useful if it connects to actionable awareness rather than abstract contemplation. The COMEX July 2026 contract's first notice day is approaching, with open interest of approximately 40,380 contracts, representing 201.9 million ounces of paper silver still outstanding against a registered inventory of approximately 86 million ounces. That 16% coverage ratio is described by exchange analysts as tight. As the roll process proceeds and the July contract transitions to September and December delivery months, watch whether open interest rolls cleanly or whether delivery demands emerge. A surge in delivery notices, contracts standing for physical delivery rather than rolling to later months, would be a significant development. It would indicate that the buyers holding long positions are demanding real metal, not cash settlement. That is the mechanism through which physical tightness converts into price discovery. Watch the Shanghai premium. If it compresses, if Western prices rise or Eastern prices fall and the gap narrows, that suggests the arbitrage mechanism is functioning and physical supply is moving toward equilibrium. If the premium persists or widens, that is confirmation that the physical market remains disconnected from the paper price in ways that are structurally significant rather than locally explained. Watch Federal Reserve communication, Chair Warsh's press conferences, and the July FOMC statement will provide the next definitive read on whether the hawkish shift is deepening or moderating. If the Fed signals that the peace-driven decline in energy prices has reduced inflationary pressure enough to take September hike risk off the table, real yields could compress and precious metals could recover sharply. If the hawkish tone persists or intensifies, the macro headwind for silver deepens. Watch the US-Iran situation. The peace framework signed on June 19th is described as a memorandum of understanding, not a formal treaty. The Middle East's history of signed agreements and subsequent complications is extensive enough that prudent investors are treating this as a tentative rather than durable development. If the situation deteriorates, if the Strait of Hormuz reopens as a flashpoint, if oil prices spike again, the safe haven premium for precious metals returns rapidly, and the current macro headwind reverses. And watch, as always, the behavior of the physical market. The reports from retail dealers about product availability, premiums, and inventory depth are not official data. They are imperfect, anecdotal, and subject to all the distortions that accompany self-reported information from participants with their own interests. But they are often the first signals that a physical market is changing before that change shows up in official statistics. When dealers report back orders, when specific products become unavailable, when premiums widen beyond what exchange costs and logistics would normally explain, these are the kinds of data points that, in hindsight, analysts identify as the leading indicators of the transitions that ultimately show up in the price history. The silver story in 2026 is not a simple story. It is not the story of a metal that is obviously going up or obviously going down. It is the story of a commodity at the intersection of the most consequential industrial transition in modern history, the electrification of the global economy, and the most dysfunctional monetary environment in a generation. With inflation proving structurally persistent and central banks navigating between the Scylla of inflation and the Charybdis of recession with instruments blunter than any of them would prefer to admit. It is the story of a physical market that is sending one set of signals and a paper market that is sending another, and the slow, grinding, often violent process by which those two signals eventually reconcile. History does not provide a precise timetable for that reconciliation. It provides only the observation that, in commodity markets, the physical reality eventually prevails over the paper representation of it. The question of when that occurs, and at what price, is the question that separates investing from certainty, and certainty, in markets, is a luxury that no one can honestly offer you. The individual sitting with silver in their hands this weekend, in their safe, in their vault, in the mint-sealed tubes stacked in their closet, is making a decision that connects to forces far larger than any individual portfolio. They are, in a small but not insignificant way, participants in a contest between the paper representation of value and the physical substance of it, between the institutional machinery that benefits from the continued primacy of the paper price and the structural reality of a commodity that the modern world genuinely cannot do without, between the short-term logic of a macro environment that punishes non-yielding assets and the long-term logic of a supply deficit that cannot be resolved by a central bank press release. That is not a trivial position to occupy. It is not comfortable. Watching a metal fall 47% from its all-time high is not comfortable for anyone, regardless of how compelling the long-term structural argument appears in a video essay. The discomfort is real. The losses for those who bought at the high are real, and the uncertainty about the path forward is absolute. What is also real, however, is the physical data. The 86 million ounces of registered silver backing $14.6 trillion in paper claims at a 6.2 times leverage ratio. The sixth consecutive annual supply deficit. The elevated Shanghai premium that persists despite the incentive to close it through arbitrage. The mine production that cannot be increased on any timeline relevant to the current decade's industrial demand trajectory. The institutional research community that has moved in the span of 18 months from treating silver as a monetary relic to modeling outcomes between $135 and $309 per ounce. These data points do not guarantee a particular price outcome. They describe the structural foundation beneath a market that is navigating extraordinarily complex and volatile conditions. They are the reasons why the question of what happens to the physical silver market in the second half of 2026 matters not just to those who hold the metal, but to anyone who wants to understand the relationship between the price of things and the real-world availability of them. Now let me ask you something directly, because the comment section of any serious market discussion is often the most valuable data source available, not because anonymous internet commenters have access to institutional research, but because they have access to something arguably more important, ground-level reality. If you are a silver holder, if you buy from dealers, if you watch this market from a position of direct engagement with the physical supply chain, what are you seeing right now? Are dealers in your area showing genuine inventory constraints? Are premiums elevated beyond what spot price math would normally justify? Or does supply feel adequate and pricing feel normal? Type what you are experiencing in the comments below. The collective picture that emerges from those reports is genuinely informative, and it is the kind of distributed intelligence that no single analyst can replicate from an office in New York or London. The silver market, in June of 2026, is a story about the tension between what screens say and what vaults hold, between what institutions need the price to do and what physical reality will ultimately allow, between the short-term logic of monetary policy and the long-term logic of industrial necessity. It will not resolve cleanly or quickly. It will involve further volatility, further headlines that seem to promise resolution and instead deliver only more complexity, further moments where conviction is tested by price action that makes the structural argument seem temporarily irrelevant. But the structural argument does not require a particular Monday morning price to remain valid. It requires only that the deficit continues, that industrial demand continues, that registered inventories continue their long-term decline, and that the physical market continues to tell a different story than the paper price suggests. On all of those dimensions, as of this week, the structural argument remains intact. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in mind.